Big news from the Fed today. Chair Jerome Powell said the recent rate cut was driven not by hit-or-miss inflation numbers, but by increasing risks to the job market, slowing labor, rising unemployment. Those downward risks are now front and center. Chairman Powell describes the current policy stance as modestly restrictive and reiterates the Fed's commitment to its dual mandate, maximum employment and 2% inflation over the long run. But don't expect rate cuts at every meeting, he said. The path forward will be slow, data-driven, and highly dependent on labor market performance. Okay, enter Austin Goolsbee of the Chicago Fed. He echoed many of the same concerns about elevated inflation, but stressed something critical. The data coming out of the BLS has been unreliable lately. He announced that the Chicago Fed will now be releasing a new indicator called CHURN, Chicago Fed Unemployment Rate Nowcast. CHURN blends official BLS numbers with real-time data, job postings, ADP, Google Trends, and it'll be released every 2 weeks. That will give us a much clearer road on what the labor market is actually doing. Then there's Stephen Miran. In his speech at the Economic Club of New York yesterday, Miran dissented from the recent Fed decision. He argues rates are already too high. He called the policy today overly restrictive, warned of unnecessary layoffs, and believes we should be faster on the cuts. He even claimed that neutral interest rate has fallen, in part due to shifting immigration and tariff policies. So what does all this mean for mortgages and your financial strategy? Mortgage rates are tied to what markets expect, not just what the Fed does. If churn shows the labor market weakening faster than the BLS reports suggest, that would give more weight to Miran's view that cuts should be more aggressive. If Goolsbee's new data streams show inflation easing, that helps too. If you're refinancing or shopping for a home, now is when it matters most. Don't overpay points or lock in long periods thinking rates will be going higher. With multiple cuts likely coming, you'll want flexibility and timing on your side. So follow me to master what comes next in mortgages, because when labor data shifts, your rates shift too.